I'm Nick Grove for Morningstar.com.au, and today I'm joined by Head of Equities Research Peter Warnes, who's here to give us his take on the FY15 earnings season, which drew to a close last week. Peter, thanks for your time today.
Thank you, Nick. Good to be back here.
First of all, Peter, it's been an interesting couple of weeks in global markets. With all the uncertainty surrounding China and the Fed's next move, is there a new crisis brewing, or is this just an opportunity for investors to pick up some quality companies?
Nick, it's always, you've got to be careful when we use, kind of emotive kind of adjectives like crisis and that type of thing. Look, I don't think there's any crisis out there at all. The GFC was a crisis because it was based on subprime loans that basically were worthless. And so the underlying platform that the house was built on, and the foundations were weak, and that did create a crisis. This situation last week came about because markets had been elevated. The markets were looking for the Fed to do something in September, but the portfolios were set for growth. Because markets were elevated, the PEs were higher, they were looking for growth to come through. Disappointing data coming from China finally broke the patience, if you like, of the portfolio manager. Now, if you look back and have at August derivatives, the August New York derivatives, the imbalance between the puts and the calls was at record levels. So the portfolio manager was sitting there with physical stock, but with a very, very bearish derivative stance. As soon as these disappointing data come from China, they said, right, we're going to exercise the puts. They exercised the puts. This market was driven down by derivatives, by hedges, hedge funds, and all that type of thing, and that was the reason. The slowing economic growth in China is not a crisis. It's not going to stop the US economy growing. I mean, it's just been shown the US economy second quarter GDP, up from the first three to 2.3 to 3.7, tells you that the US economy is recovering and recovering in a robust manner. So that no, this is not a crisis. This was and is an opportunity to buy stock, quality stock, and that's what our people have got to be looking for. Make sure you have a shopping list. When the prices hit that wish price, if you like, then put some money on the table. And that gave you an opportunity last week to do that, and you can continue to feed money in. Now, you've got the market now in Australia. The PE's back from about 16.5 to 14-ish, and the yield now is just over 5%. And you can pick the fully franked yields there. They're very, very elevated again. Now, that's where you should be shopping. Moat, medium uncertainty to low uncertainty, nice yield, etc., you're allowed to put money on the table. So, crisis no, opportunity yes.
Back on the local front, Peter, we saw a number of large caps delivered their earnings as we rounded out earnings season last week. Now, BHP saw its profit fall quite a little bit, but it's still delivered on the dividend front. Are you still confident BHP can deliver for shareholders going forward?
Well, Nick, the short answer is I think they can. How they get there is a matter of what amount of debt they are willing to take onto the balance sheet to underwrite, if you like, or underpin the progressive dividend. Just watch for these, again, emotive sentences that say the payout ratio is 200%. That's the payout ratio on the earnings. You focus on the free cash flow because that's where the dividend comes from. We know there's three buckets where free cash flow can go: reducing debt, growth capex, and dividends. So that BHP's free cash flow in the year just ended, yes, down, but 7.2 billion, and will be down again in 16 and 17 if commodity prices stay where they are. And you've just seen a 20% jump in the oil price in the last 3 days. So all you know is that commodity prices aren't going to stay steady. They'll be jumping all over the place. So watch the free cash flow. So in the year just ended, the gearing ratio net debt to equity was 37%. We're looking for free cash flow to come down from 7.2 to 5-ish, and then maybe a little bit lower than that in 2017. But even a little bit more debt and pushing the gearing ratio to 40%, which is not, out of this world, they can sustain the dividend at current levels. Now, if there is a rebound in commodity prices, then they may well entertain a slightly higher dividend, but I wouldn't be counting on that. I think 124 US cents looks, like cast in stone for at this point in time for another year or so. And so, at kind of prices sub $25, that yield is fairly attractive.
Peter, Wesfarmers delivered above expectations, but Woolies seems to be struggling a little bit. But do you think both of these companies are still worthy of their narrow moats?
Yeah, Nick, that's a good question. And look, again, the answer is yes. Woolworths has disappointed, and we know the reasons why. But the return on capital or investor capital, ROIC, is still very, very high. It's got a big 2 in front of it, way above the cost of capital, and that's our moat benchmark. And we don't expect the return on invested capital to come anywhere near the cost of capital over the next decade, at least. And so, yes, Woolworths has still got a narrow moat. It's got some work to do. If I was Gordon Cairns, the first thing I would do is I would send a message to the market. It's got nothing to do with earnings. That we want to be leading, and we want to be a leading company in terms of what we do for shareholders and what we do for the financial community. I think it's a disgrace that Woolworths are reporting on the last day of the reporting season. They are a leading company, not complicated. They should be reporting 3 weeks earlier than they do, and they should be paying dividends much earlier than they do. If I was Gordon Cairns, I'd be resetting the financial calendar and putting a much, much better look on the company. Then get down and have a look at what's going on in the nuts and bolts. And there's plenty of work to do, but the game is not over there by a long shot. We are still comfortable with our valuations on Woolworths, and it certainly looks an opportunity for patient investors. It's going to be, you have to be patient, but the yield is there to compensate you for that. The yield at 5.2%-ish is sustainable. The payout ratio at 70% is not a problem. Wesfarmers is a class act. The results there were better than expected. The dividend payout is high because the predictability of the earnings stream and the cash flow out of both Coles and Bunnings in particular. So it certainly deserves a narrow moat. It's still feeling the pain of the equity issue way back when they took over Coles and had to issue equity at $13. But they're starting to hit their straps, and the cost of so the return on invested capital will exceed their cost of capital comfortably going forward.
Peter, thanks very much for your time today.
Thanks, Nick.